Hello there. Okay, today we're going to discuss the Mortgage Types Basics 101. Here we go. So the first thing I want to distinguish is what is a residential loan? So residential loans are considered anything to be 1 to 4 units, single family home, duplex, triplex, fourplex. Anything above 4 units, commercial. 5 units, 10 units, 50, 200, apartment buildings, that sort of thing. It's all commercial. So within the residential identification, there we have two major categories, non-government and government. Okay, so in the non-government, you got conventional, jumbo, non-conforming. Under government, you have FHA, VA, USDA. So just to let you know, the conventional single-family type of loan is the most popular loan program being used in any marketplace. It varies, but anywhere between 70 and 80% of all loans that originated to buy a home are conventional loans. The maximum here in Oregon is $726,200 for a single family home. Okay. Now, conventional loans will finance up to 4 units. So single family homes, duplex, triplex, fourplexes, and the loan limits increase for each unit. So if you want to buy a duplex, there's a higher loan limit up to a fourplex. Now, under the single family residence, we have also townhomes, condos, and manufactured homes. Keep in mind, a manufactured home, it cannot be on a lot or someone else's land. It's got to be on your land to finance that. It's got to be permanently attached to a foundation. Okay, the conventional loan program also has a wonderful 3% down only for first-time home buyers. Now, a first-time home buyer is defined as someone that has not owned a home for the last 3 years. So 3 years and 1 month, you qualify. Also under this program, if there's a borrower and a co-borrower, only one of them has to meet that guideline. So let's say there's a borrower and they have not owned a home in the last 3 years, and there's a co-borrower that has owned a home, let's say a year ago, you would qualify under this program. Only one person has to meet that guideline. Conventional loans follow the guidelines set by Fannie Mae and Freddie Mac. Funny sounding names for serious financial institutions, right? Fannie Mae and Freddie Mac. So here's the question. How come mortgage companies never really run out of money? I don't know if you pay attention to this or not. That's what I do, right? But they can lend millions and millions of dollars monthly, billions yearly, and they just never run out of money. And the reason why is something called the secondary market. And there we go again with that Fannie Mae and Freddie Mac fellas. I think Fannie is a female and Freddie is the male, right? But who knows these days? Anyway, so Fannie Mae and Freddie Mac, they are large financial institutions in what's called the secondary market. And what happens is when a bank, a mortgage company, or credit union, or any other retail lending institution finances a loan under their guidelines, then they can sell them that loan and get their money back so they can go out and make another loan. So it makes mortgage money readily available in large quantities, and it's a wonderful, wonderful system. So what happens is Fannie Mae and Freddie Mac, they collect all these loans, hundreds of thousands, millions of loans, and they pool them together in these big batches, and they securitize them through Wall Street, and then they sell them to large institutional investors like pension funds. So if you have a pension fund, it may be a part of that pension fund has money invested in what's called mortgage-backed securities. The mutual companies buy them for their investors. Foreign banks buy them, central foreign banks buy them. So there's anyone that's got millions of dollars to invest, they like to have, a lot of times their portfolio consists of mortgage-backed securities by the U.S. In the U.S. Because it's a very safe investment. It's a good return on their money, and it's a wonderful system that makes a lot of money available to U.S. residents to buy homes. You know, in many parts of the world, they don't have a 30-year fixed mortgage. They're adjustable after a few years or so forth. So people have to deal with that, you know, every couple of years, rates go up and down. They don't have these low money down deals in many parts of the world, or no money down. We do. So, and one of the reasons is because we have the secondary market that works really great. So under the government type of loans, there are three: VA, FHA, and USDA. So I'm going to give you a quick rundown of each one. Let's start with the VA, which is for veterans. So if you're a veteran of the military, you are entitled to a loan with no money down. Now, it's guaranteed by the U.S. Department of Veterans Affairs, but the government, the Veterans Affairs, does not lend you the money directly. What you do is you go to a lending institution like a bank, a credit union, a mortgage company, and they lend the money out, and the VA insures them against any losses because it's no money down. Otherwise, they wouldn't do a no money down type of loan transaction. They're available to active duty military personnel, okay, and veterans, and in some cases, surviving spouses. So that's pretty good. Again, the main benefit is no money down, and it's a really great loan program. And they have pretty good rates right now. They're a little bit below conventional loans. So I like this program, and my son has used this program to buy his first home. He sold it, and soon he's going to buy another one. So you can use the VA benefit to buy a home, sell it down the road. You got to move, whatever happens, life events, then use that benefit again. And if you want to do it again and again and again, it's a never ending benefit. So it's not like a one-time use and that's it. They will finance 1 to 4 units, although the most popular one is a single family home. Always the single family homes are going to be the most popular programs, even though in all of these categories, in different loan programs, most of them do allow 1 to 4 units. However, if you buy one with units, meaning you live in one and rent out a second unit or third or fourth, there are additional restrictions with the VA loan. So you have to look into that. So keep that in mind before you get too excited about that. But it's a good program all around. FHA, okay, that's insured by the Federal Housing Administration. Again, the same concept. They don't lend the money directly. Private mortgage companies, banks, credit unions, they lend out the money, and they just get insured by the FHA. That's why they're able to do a low down payment of only 3.5% down. The whole idea of the FHA loan is to help homeownership, make it more affordable, and they also entertain homeownership buyers with lower credit scores. They'll go down in some cases below 600, okay? There are other conditions involved when you get there. You're going to pay a higher rate, but keep that in mind. It's a good way to get in if you have a lower credit score. If you're in the low 600s, definitely. Most lenders will go down to a 620 credit score. So keep that in mind. 3.5% down, pretty good. And they will finance up to 4 units, although the single family home is the most popular program. However, I've had clients buy a duplex. They live in one, rent out the other. It's a good way to start out. Maybe you can use that as an investment down the road. You can move out of that unit eventually. You know, you can't go there with the intention of, you know, moving out right away, because that is a no-no. But if life circumstances happen and you have to move out in a year or so, it's legitimate. Yes, you can rent out all the units and so forth. You don't have to be a first-time buyer to get an FHA loan. You must occupy one of the units as your main resident, whether it's a single-family home or a duplex, triplex. So it's got to be owner-occupied as your main residence. Another really good benefit about the FHA, they allow co-signers to help you qualify. So let's say you don't qualify for the payment, or now you would think, why would you buy a home if you don't qualify? There are many reasons, but I'm not going to get into that. But you can get a co-signer to a family co-signer, a relative of some sort, and they can co-sign for you. Other loan programs don't allow that. The FHA does. Let's talk about the other government program, USDA. guaranteed by the U.S. Department of Agriculture. Okay, this is designed to help make homeownership more affordable in rural areas. So we have some of those around here, right? Lots of rural areas. So basically, they have some guidelines, and only properties in certain eligible areas qualify. So you have to. Here's the big tip. The home has to be in certain designated areas. You can't just say it's going to be outside the city limits. For instance, like in Southern Oregon, Grants Pass no longer qualifies the city limits. Medford does not. Central Point does not. But there are areas outside that do qualify. And the USDA has a website with a map. You type in the address and it'll tell you whether it's eligible or not. This is really important because I've seen property advertised for sale that they'll go USDA and they won't. And that's going to be a disappointment because when you order the appraisal, you're going to get a rejection. And guess what? You just spent money on an appraisal, and appraisals are not cheap. So keep that in mind. Always be aware of that. There are two types of USDA loans. The most popular one and the most widely used is the guarantee program. And in this case, there is a program with USDA where they lend their money directly. They have a really good interest rate. There's a lot of guidelines you have to follow. They're very limited inventory of which homes they'll do. And so I have never gone in that arena because it's a real pain. I don't recommend it. And it could take months and months, even 6 months before the deal closes. Just be aware of that. I'm just laying it out, but that's what's going on. Now, what if you want to buy a multi-million-dollar home? Well, then you're going to need what's called a jumbo, as the name implies, a jumbo loan. So if you need to buy a home that is in the millions of dollars, $1 million, $2 million, $10 million, $20 million, whatever have you, then you're going to look for a jumbo loan. That's what jumbo loans do. They finance that. Anything above the conventional loan limits. And then the last category is called the non-conforming. These are loans that don't conform to the other guidelines, Fannie, Freddie Mac, conventional, government. There's a category of loans called non-conforming. There's certain select private lenders, of course, that do this. The rates are going to be higher. The fees are going to be higher. Type of loans they do, that's one of the more popular ones, is going to be limited documentation. So let's say ideally for self-employed or independent contractors, their tax returns don't show well. These lenders will take bank statements to show what sort of income was coming into your business. So this is a place that you can entertain. And that's it, folks. Just a little bit about our company, and what we do is we have a one-stop home buying service where we help you find, buy, and finance your home in an easy and convenient manner. And we also save our clients quite a bit of money doing that. And feel free to give me a jingle. My name is Bruno Skopinich. I've been active in the mortgage and real estate profession for over 29 years. So I know a lot about both of these industries, kind of blend it all together, give you the best of the best of the best. So anytime you want to give me a holler, free consultation, no obligation, get a second opinion, whatever you like. I'm happy to share information, everything that I know, and I tell you straight. I don't make things up. And that's it. Till next time. Bye.